Hello, everyone, and welcome to this edition of Florence Live, the series of conversations on topics focusing on policy issues that cross borders. We are live from Florence in a discussion organized by the School of Transnational Governance of the European University Institute, where we teach and train governance beyond the state. My name is George Papaconstancinou. I'm a professor of international political economy and director of executive education at the School of Transnational Governance, and I will be moderating today's session. Our topic is Europe's COVID crisis response. What have we learned from the financial crisis? Put another way, does Europe ever learn? We all know that the COVID-19 crisis has hit European countries hard. The crisis at the same time has elicited an innovative policy response at the EU level, a response that breaks in many ways with previous practice in terms of both the tools that are being used and the institutional arrangements being put in place. But does this policy response simply reflect the different nature of the crisis we have at hand? To what extent does it also incorporate the lessons that we learned from the previous financial crisis? Is it appropriate and adequate for the problems the EU is facing? And will it fundamentally, looking forward, change EU economic governance? To discuss these questions, we have with us a very distinguished panel. We will start with a presentation by Marco Buti, who is head of cabinet of Commissioner Paolo Gentiloni, responsible for economic affairs and taxation at the European Commission. Marco has a long and distinguished career at the Commission, where he was Director General for Economic and Financial Affairs for 10 years, and crucially throughout the Eurozone crisis period. I had the privilege of working with him that difficult time as the Greek finance minister. It was not always easy. We did not always see eye to eye, but it was always a relationship of trust and respect. Mr. Buti has published extensively on the EMU, macroeconomic policies, structural reforms, the welfare state, and unemployment. And if I may say, despite his long institutional attachment, he has preserved a clarity in his thinking about EU affairs and governance that transcends the roles he has had and makes his views always extremely interesting. Marco, thank you for being here. We're also privileged to have two distinguished discussants. Adam Posen has been president of the Peterson Institute for International Economics since January 2013. During his presidency, Peterson has won global recognition as the leading independent think tank in international economics. And over a long and distinguished career, he has contributed to research and public policy regarding monetary and fiscal policies in the G20, the challenges of European integration since the adoption of the euro, China-US economic relations, and developing new approaches to financial recovery and stability. Good morning, Adam, and thank you for being with us. And last but by no means least, our own Brigid Laffan, who is director and professor at the Robert Schuman Centre for Advanced Studies at the EUI. Brigid is a political scientist with a distinguished academic career and an important voice in the European governance discussion. Before joining the EUI, she was professor of European politics at the School of Politics and International Relations at University College Dublin and the founding director of the Dublin European Institute. Her strong voice in European affairs is widely recognized, as, for example, when in 2018 she was ranked among the women who shape Europe by Politico. Thank you for being here, Brigid. We will start with Marco Buti, who will give a presentation supported by slides for about 10 minutes. Adam and Brigid will then give a first reaction before we move to a conversation. During the conversation, I will introduce questions from those of you following our event, which is live streamed on the Transnational Governance website and on the YouTube channel. So please send us your questions as the event progresses by writing into the chat function of YouTube. Marco, the floor is yours.
Thank you very much. Thank you very much, George. Great to be here. Thanks to Brigid and Adam also. Nice to be among friends for such a I think a very relevant topic. I have a few slides, as you said, and let me also congratulate the School of Transnational Governance. I mean, we are looking to this as a bright example of what Europe can bring to the discussion, but also to improving the human capital throughout Europe. So congratulations for this also to Alex Stubb, who is the director of that. Now, I have a few slides, as you said. I think we can start. We can go to the first one after this. And here we are. Now, what I have here is a picture on the outlook, the way we see it, the way we saw it in the winter forecast, which was published about 10 days ago by the Commission. And I try to capture here, I think, many, several information. Comparing also the current crisis with the beginning of the financial crisis. What emerges from here, essentially, in my view, 5 messages. The first one, and when you see it, when you have a lot of up and down here, huge uncertainty. That's the name of the game which remains in front of us. Second point is that the shock is very large. For several countries, twice or more than twice the huge shock of the financial crisis. You can compare here the euro area with the 2009 with the euro area 2020. So it's larger than what was considered to be an epochal crisis. Third message, the US recover is less affected, huge shock as well, but less affected than Europe, and bounces back stronger than Europe. Basically, if you, as a yardstick, Europe comes back to the pre-crisis level 2019 in the second half of 2022. The US comes back to that 1 year in advance. That's our forecast, and obviously does not factor in a number of measures that are still under discussion on the other side of the Atlantic in particular. Fourth message, the shock is common in origin, but asymmetric in outcome. So you can see it here, and there is no need to elaborate too much on that. Fifth, very important message is that these short-term divergences looking forward are superimposed on longer-term structural divergences, and you see that on the right-hand side of the slide in the little boxes there. Within Europe, you have compared to 2008, so forecast 2021, 2008. So what has accumulated throughout 2 crises? Germany plus 12%, Italy still minus 8%. So you have 20 points difference within Europe. So this divergence that has accumulated. As a reference, you have the US 21% over 2008. In Europe, this translates basically, given the very similar demography in GDP per capita. For the US, that you cannot do because of the demography is more dynamic in the US, but the difference is large anyway. So I think you should keep this in mind, because this actually underpins the 2 R's of the Recovery and Resilience Facility. So the recovery, the first R, so the need to help in the bouncing back and of the economy in the short term, but also the second R, which is the resilience. So to make sure that we grow in a sustainable way looking forward, in order to reabsorb eventually these divergences that have accumulated over the years. If you go to the next slide, I have tried here so next slide, please. Here we are. Okay, inconsistent trinities abound in economics. You start from the most rigorous one being the Mandel, which actually underpins the euro on free capital mobility, fixed exchange rate, independent monetary policies. Then there have been other trilemmas. What is here? What is behind here is basically the globalization trilemma of Danny Roderick, published in 2007, which I have twisted somehow and made it relevant, in my view, for the European economic and political integration. So you cannot have at the same time the political integration, democratic legitimacy at the level essentially of the member states, and all the decision making based essentially on national institutions. So what you have here is that there are different ways three ways to solve the dilemma. I mean, the first one is which basically is the what was adopted or emerged from the establishment of the single market and economic and monetary union in 1980s and 1990s, where decision making actually was taken at the European level, so not only at the national level. You have the point B, the solution B here, instead is the intergovernmental solutions, which, as I would argue, were essentially prevalent during the financial crisis. So there is an issue here of democratic legitimacy, because in a sense we violate what we all love, which is the so-called community method. And finally, which is C, which was actually the example here, is a non-solution, basically, where democratic legitimacy and national institutions were kept together, but we did not find a proper solution. This was the case of the handling of the immigration crisis of the mid 2010. So this is, in a sense, in just a few seconds, given a bit the history of European integration of the past 30 years. My claim here is that the COVID-19 crisis, we have a chance, not a certainty, a chance to have to exit the trilemma via solution A. So we go to the next slide, and here we have the what I have compared in financial crisis and the COVID crisis along a number of dimensions. I'm not going to explain all this because it would take too long. But what you can see is that if you glance at the first, second, and third column, you'll see that at least in my interpretation, it can be subject to discussion, obviously. The sign of the response and the interpretation between the financial crisis and the COVID crisis actually change. You mentioned, George, in your introduction, I think what makes the difference, or an important difference in my view, is the nature of the crisis. So whilst the financial crisis, which was magnified then in the sovereign debt crisis of 2010, 2011, was essentially viewed at the time as a policy-induced shock, so something that we brought on ourselves. COVID crisis is essentially seen as an exogenous shock, on which nobody bears the direct responsibility for. So this has helped in fending off the moral hazard view on the policy response, which marked the response during the financial crisis, which led to the most pernicious division, in my view, in Europe, which is a creditor versus debtor countries. And so you can actually scroll through and look at the response. You can see that I think it was slow and only the ultima ratio in the financial crisis. I think for European standards, what was decided last year was actually very fast. Also on the conditionality, I think we are more emphasized on national ownership rather than creditor rules and market-based or something imposed, in more common and community method rather than intergovernmental. where the sign is different, but here in a somewhat unexpected way, is on the international cooperation. I have here Adam, because the international cooperation and the rise of the G20 was an important development during the financial crisis, and actually has been, I believe, Larry Summers in a blog for Peterson, who emphasized that this shock here, which is, let's say, in a sense more common, would have lent itself to more coordination, which actually did not happen at the international level. So this is an important consideration. So we go to the next slide. What I do here, I try to elicit in a synthetic way the lessons that hopefully we learned. We are still learning institutions, George, during the financial crisis, which actually is relevant for, in my view, for this crisis. And here, let me thank again Adam, because I presented a paper in Peterson at an event that Adam organized for when I retired as Director General. So I tried to, I reflect on those issues at the time, and I put it here in a synthetic manner. So I mentioned it before, I think the way the crisis unfolded tainted the narrative and the interpretation of that. Here I tremble a bit looking at George, but I would tend to say that had Ireland been the first country entering the crisis I think we, rather than Greece, I think we would have had probably, we would be telling here a completely different story.
I have made that point many times.
Okay, made that point many times. So I shouldn't tremble then. You can, and what I have done in the second column here is in a very subjective way put the pluses on those lessons to the degree of relevance for the present crisis. So you have the nature of crisis, certainly. Then you have a block in the middle of the slide on risk sharing, monetary policy, fiscal policy, policy mix, fiscal stance, which basically tells us that you have a certain amount of risk sharing, in my view, that is needed in EMU. You can get it directly, or you can get it a bit by stealth. So directly, you get it through national budgets or by the EU budget, or you can get it a bit in a less transparent way via the ECB balance sheet. This second option was the one chosen during the financial crisis, and I think was probably more convenient at the time. But also the Karlsruhe ruling indicated that this only going via the ECB balance sheet can actually risk to push the ECB towards, say, the limit of its mandate. We learned also that declaring victory too soon is a mistake. So a too early withdrawal of fiscal stimulus can be very, very costly, especially when you have the monetary policy at the effective lower bound. And finally, an appropriate fiscal stance for the Eurozone as a whole, very difficult to achieve simply by horizontal coordination on national policy. So you need a vertical coordination, I think, with a central instrument. The only one that we have now is the EU budget. The comment I made before on global governance, I think, is important also here. I think one has to be honest and conclude that stumbling from crisis to crisis during the financial crisis on the EMU certainly weakened the geopolitical role of Europe. And now this Commission, this Union wanting to play a more important role also geopolitically, I think cannot afford, in a sense, to stumble like that. So that is what I think we have globally learned from the financial crisis, which is, I think, relevant for the design of the policy response nowadays. So we can go to the next slide. And what I think, from what I have said so far, I think it is quite evident that I think that what we did during the financial crisis was, I think, politically inevitable in certain cases. but certainly not optimal in several dimensions. And in order to assess the policy, the coherence of the policy response, I put up here what I call a Monet compatibility test, starting from what in this forum here and in the audience, I'm sure everybody knows, has heard, which is the Monet dictum that Europe will be forged in crisis and will be the sum of the solutions adopted for those crises. We have heard that so many times. And it is true. At the same time, I think in order to assess whether these solutions are right and appropriate, then you have to pass three tests, or a test in a three-pronged test. Economic coherence, so the effective response. Institutional coherence, so subsidiarity being respected both up and down, and also political coherence, so citizens enjoying the citizen support. So what I think we should do is now eventually assess what is we have put in place through this prism of this Monet compatibility test. So we can go forward, keep that in mind as let's say, conceptual prism for that. We can go to the next slide. And here is what we put together and what we did in 2020. So at the national level, this is what was done in terms of fiscal and liquidity. This is 20 measures adopted in 2020. For the EU, you see this multiplication of acronym, but I think we had the measures taken by the Eurogroup, SURE, so the support for short-term work schemes, the ESM, the pandemic facility, having taken out all the macroeconomic conditionality typical of ESM programs, and EIB credit support. And then the big chunk being next generation EU, because there, I think we break a taboo. In a sense, we cross a red line that has been there in the past, because we have, on the one hand, we have fiscal transfers, so not only loans or back-to-back loans as we had in the past during the crisis, but also on the revenue side, 750 plus billion that will be common debt issued by the European Union via the European Commission. So with the European Commission, and we are equipping ourselves right now, becoming a very important debt management office in Europe. So pushing the Commission towards becoming gradually basically a treasury for the Europe and for the Eurozone. And then the response of the ECB, so the PEP program, with a very, very large increased over time purchase of assets beside the decision on the remaining negative on the interest rates. So this is what is a snapshot of what has been decided. For the national is 2020 measures. The others are over time. For next generation EU, now the decision has been made at the European level. Now the own resources decision have been adopted at the national level, because you need parliamentary support. And then the actual plans which are being elaborated will be presented in the next weeks and before the end of April, and then implemented with commitments by 2023 and payments by 2026. So this is what has been decided. We can go forward, and what I have done here is again, in a synthetic way, try to present what has been decided in terms of institution and in terms of rules-based systems. Okay, and you can see the different colors, so intergovernmental, supranational and mixed. You cannot tell immediately from looking at the table, but what is essential here, the message from this, is that the essence, not all, but the essence of the response during the financial crisis was basically intergovernmental. Not all. For instance, we had the single supervisory mechanism of banking union, but the rest, which is the ESM, and then also the fiscal compact, are commitments and decisions which have an intergovernmental nature. So you do not draw the conclusion immediately, but if you wait in terms of political and institutional importance, intergovernmentalism basically largely dominated during the financial crisis. I'll come to that to the conclusions a bit for more comments on that. On the during the crisis here, I think yes, there was some intergovernmental element like on the ESM pandemic crisis support, but the essence, what is clearly important, is the recovery and resilience facility, next generation EU via the EU budget, and on the rules-based, the activation of the general escape clause, which has also been, I think, a very important decision, together with decisions on relaxation of the state aid framework. So we confirm here more the community-based approach versus the intergovernmental approach. We can go to the next slide, which is basically my final one. And here I throw my heart beyond the obstacle and do something which is not very, which takes a bit of risks, but it's my own responsibility fully. So do not attribute the Commission to anybody else. But I try to also to provoke a bit Brigid, to try to get a bit of a political reading of this. How come we have managed to bring about a different response compared to the financial crisis? And I have positioned here the countries into the two axes, which is the horizontal one is a supranational, so community method versus the intergovernmental, and on the vertical axis, the responsibility versus solidarity. So basically responsibility being on the risk reduction side and solidarity being on the risk sharing side. So where some of the countries, so the key players during the financial crisis, you can see clearly, okay, Germany was on the responsibility, so risk reduction and intergovernmental, and actually you may remember in 2010, Mrs. Merkel came to Bruges and gave an important speech there, and she coined the union method compared to the community method, which gave the prominence in the decision-making on strategic issue to the European Council, which is a typical intergovernmental body. So that was that. So, and the management of the crisis became Chefsache. So it's a matter for the bosses. So that was the position of Germany. Clearly, in this crisis here, Germany has shifted quadrant. I think the element of solidarity, or if you want, you are a bit more cynical, you can call it as enlightened self-interest, would move it so towards, let's say, putting more emphasis also on solidarity and definitely on the budget, union budget, so being on the supranational side. France shifted across. Others remained in the quadrants, but somehow had in the overall equilibrium, I think, had to accept certain decisions which were not always very much in line with their initial preferences. Now, the big question, and I end with this, is what we are putting together a big one-off, or is it a paradigm change in European integration. And what are the conditions for that? So is it huge one-off in response to a huge crisis? We do something for a few years, then we forget. Or is it, Hamiltonian moment? Some would say a Rooseveltian moment, or coming on this side of the Atlantic, Delors type of moment. So with you remember the white paper of Delors, beginning of the 1990s. So I think the answer relies on two movements, in my view. One is on Germany actually confirming the shift of the quadrant, not only on Next Generation EU, but also eventually on economic and monetary union. So on the completion of the architecture of EMU. So this is one condition. The second condition is that Italy and Spain travel vertically towards more responsibility. I think should this happen, then I think what we have put in place has a chance to become really a historical shift in European integration, and we would overcome this very damaging division between creditors and debtors. If these two conditions happen, I think these conditions will be, I think, actually fulfilled. Latest development, at least in the country where you are sitting, I think would make me relatively optimistic. And let's hope that having put all this into place during the period of electoral peace, which was in 2020, that this will be confirmed also in a more electorally challenged period, which is the months in front of us. Thank you.
Thank you very much, Marco, for a presentation that deftly kind of combined economics, politics, and institutions. I have loads of questions, but I'm going to hold on to them and give instead the floor to Adam Posen.
Thank you, George, and thank you to Florence Live, or Live from Florence. The series has been quite impressive, and I'm honored to be part of it. EUI continues to be a good influence for sensible, rightly valued economic policy. A number of my colleagues at Peterson benefited from tenure at EUI. As Marco said, he did begin talking about some of these issues in his sort of farewell but not farewell lecture at the Peterson Institute a year and a half or so ago, which I'm grateful for. And I think that, combined with this lecture and other statements in between, do tell us that the Commission learns, in part through the leadership of individuals like Marco, but it's not just him. And we have seen a very significant shift in the pragmatism, in the empiricism, in the relevance of the Commission. As you said, George, when introducing the subject in your role when you were Greek finance minister, relations with the Commission were done in good faith, but there were definitely points of conflict. And I think, were we back in that situation, to some degree, there would have been less conflict now. So I think the fundamental question of learning is there. That said, have we learned enough? And the answer is probably not. I think Marco's slide 5 from his presentation, listing the major lessons and how relevant they are to the coronavirus, is intellectually very sound, but I think it leaves out sort of two aspects, and this is where Brigid may also have things to add as well. The first is that it doesn't quite give enough credence to how much the economic thinking on fiscal policy has caught up with reality. Obviously, I think the leading figure in this is my colleague Olivier Blanchard. Others, of course, have been associated with this. But I mean, this is a battle that we've been fighting intellectually for 20 years. I mean, I remember fighting with Reinhardt and Rogoff on their absolutely arbitrary and ridiculous 90% GDP debt to GDP ratio people threw around. I remember warning people starting in the late 90s that no, Japan's public debt even at that level, was not going to blow up the world. That I remember with support from the Commission, including from DG ECFIN, a volume we did on the Euro's global role in 2004, 2005 at Peterson, in which we pointed out various hypocrisies and inflexibilities of the Stability and Growth Pact as it was practiced before the crisis. Obviously, it took us a long while to get here, and the experience of premature austerity, not just in the Euro area, but in the UK, in the US, in Japan, in 2010 to 12 was a critical turning point in this discussion. But just to say that there has been a fundamental shift, and what is disappointing, and not so much specifically the Commission or the European leadership, but the whole economic profession, was how long it took for theory and policy recommendations to catch up with what were some very obvious empirical realities, including the basic facts that there was no simple debt sustainability metric based on top-down debt to GDP levels, that rules never actually work in terms of application. They are always unevenly and politically, if not hypocritically, applied, and that R is less than G. The interest rate is less than the growth rate of the economy for long periods for most, not all, but for most of the high-income economies. And again, credit to Blanchard for pulling much of this together, but all of that should have been recognized by the profession and by including economic leadership in Europe long ago. And then the second point, which I think we have to confront, and this gets to the very creative chart, the 2x2 of responsibility versus solidarity and intergovernmental versus supranational chart that Marco put up, is that ultimately there is a core instability at the heart of Euro area, economically and financially, as long as there are not fiscal transfers or something else creating more solidarity. And again, Marco and colleagues at DG ECFIN have recognized this several years ago, and have tried to move the debate in constructive ways, and I give them credit for not being caught up entirely in state-level politics or nation-state level politics or old ideas. I think that's an example where the Commission has learned more and faster than a lot of national politicians and a lot of European economists. And we can see at the ECB, people like Philip Lane, as well as President Lagarde, emphasizing this. And that's just basically an economic reality. And so if we look at that chart, that mapping that Marco put out, that essentially means you need to move more to solidarity and more to supranational. And what we're seeing is some movement in the right direction towards the lower left quadrant in this chart, but not really enough. So as my colleague Jacob Kierkegaard has argued very optimistically, that we've had a Hamiltonian moment in Europe with the top-down COVID funds. I am a little less optimistic. I think it is an enormous breakthrough and the right move, but everybody rushing to say immediately it's specific to this crisis, it's specific to the nature of this shock, it's limited, we're not going to create a large Eurobond market. Again, for political reasons, maybe that's the reality, but I think we need to recognize that that's not good enough. We need to go further. So two final points, if I may. First, to give a cross-national perspective, which I already mentioned some of the economic facts, but of course the US right now, as we were discussing right before we started this event, is spending a huge amount on fiscal policy, far outstripping Europe on average. And some of this is the lesson of the mistakes the US made repeatedly. Some of this is the result of failures that the US has not built in a sufficient welfare state and a sufficient set of automatic stabilizers to the degree that do exist in Europe. I mean, the US is still far overshooting what Europe is providing through automatic stabilizers and welfare state, but that we had to do it through a discretionary set of one-time bills. And nobody, not even President Biden or Secretary Yellen or Council of Economic Advisors Chair Rouse is talking about major restructuring of the US welfare state and automatic stabilizers, tells you that there's still a very big distance between learning for one time versus learning and really changing structures. And in some ways, Europe has done better on that, frankly, than the US. The final point I would raise, and this is a depressing point, but my colleagues and I, notably Monica DeBola and Maury Opsfeld at Peterson, are doing a project right now on a crash basis saying, what if the variants of concern on COVID or the problems with vaccine effectiveness or the problems of vaccine distribution lead to the pandemic being recurrent or persistent in a way currently not built into forecasts? Or also just the fact that this is not going to be, unfortunately, sadly, the only pandemic that we're going to see in the next few years in all likelihood. In which case, there needs to be a real discussion at the G7, G20 level and within the European leadership, perhaps led by DG ECFIN and the commissioner, about what's the approach if we have a series of these shocks. Because one thing that was both implicit and explicit in Marco's initial presentation, which I think is legitimate, is that part of why things look different this time is because there was a sense this was a one-off shock, a temporary shock, a non-moral hazard shock. But if this is a recurring shock, and one that's going to be persistent, then some of that changes. And I think that that's an important place where the discussion has to go. I hope these comments were useful. I genuinely admire the leadership Marco Buti has shown and DG ECFIN, as I think I've said in public many times, and they're aware that they have moved a lot in the last 10 years. And it's been constructive and it's helped move things in Europe. But as ever, that doesn't mean we've moved enough because the world is what the world is. And that's the spirit in which I want to offer these comments. Thank you.
Thank you very much, Adam, for this and the transatlantic perspective in particular. I'm sure we'll come back to that. Brigid, floor is yours.
Thank you, and thank Marco for his presentation and also for asking us to think about the learnings from the financial crisis and COVID and what it tells us about the EU capacity to learn, what's changed in the EU after a decade of crisis, and how resilient is the Union. Now, most people look at COVID and say it was a symmetric shock, it was external, and therefore it wasn't quite as challenging to the EU as the wicked problems that were created by the Eurozone, the creditor-debtor. But I would suggest that it could in fact have been really much more serious. Why do I say that? COVID was a matter of life and death. It was really core politics about how governments protect their citizens, how they protect their health systems, how they ensure that money flows to households, that money flows to companies to keep them going. And you could have expected, in certain circumstances, a very strong nationalist framing of the COVID crisis. Our people, our PPE, our vaccines, our ICU capacity. And for a very small period, the first weeks of March, then that was the European response, that strong nationalist framing, and countries, the member states, trying to, in a sense, save themselves. Now, I think it's really important for us to try to understand why that was so short, because I think that tells us something about the maturing of the EU as a polity. and also what I would say the hardening of the EU after a decade of crisis. Now, I'm going to share with you some very tentative results of some work we've been doing on the framing of the COVID crisis by political parties in 7 member states. And I think it's important it's very tentative because we just have the data and the analysis is at a very preliminary stage. But we've looked at both how the media, but also political parties in the 4 larger Eurozone countries and 3 small countries, Austria, Ireland, and the Netherlands, have framed COVID, just to get an understanding, because parties are governments. So there is a bright side of the moon in terms of the results. The first is that apart from one country, positive frames of the role of the EU were much stronger than negative frames. And I think that matters. So political parties were broadly framing the EU response to COVID in positive terms. Within the negative frames, and there were negative frames, the dominant frame that was negative was EU failure, EU not doing enough. But the frames that didn't seem to catch were frames that said, well, the nation state would do better, we should go back to the nation state, or the EU is trying to grab power in health. It's using the crisis to get more power at the European level. Thirdly, in terms of the positive frames, the EU, the most positive frame was the EU as a tool and as a problem solver. So frames about the EU being part of our future or part of our destiny were much weaker across the political parties. So I think that also has implications for what matters now in terms of how the instruments and tools that Marco developed, that he outlined, how they are used. There were country differences, and what was extraordinary was, of the 7 countries we looked at, only 1 had negative frames predominating, and that was the Netherlands. And it was negative on every single negative frame, on the power grab, on Brussels trying to take away our competence, on back to the nation state. Interestingly, in France, you had a battle. The positive frames won out, but the battle was between what I would say the polarization between Le Pen and Macron. So you had those frames competing and contesting within the French political system. In Germany, it was very, very instrumental. So for Germany, the role of the EU in response to COVID was about problem solving and EU as a tool. The only group of political parties that were consistently negative were the radical right. The radical left wanted more Europe, better Europe, build back Europe, whereas the radical right were the most negative. But they didn't dominate in any of the political systems. And I think that's also a very good thing. So in terms of thinking about what we can learn from this, firstly, I think the dominance of positive frames from Europe's political parties really mattered, because it meant that Europe was not seen as the problem, but as part of the solution. Also, even those who criticized the EU did so on the grounds of policy, of the way in which Europe was handling the crisis, in other words, failure, rather than we want to return to the nation state, or that this is a power grab. In other words, it was the performance of the EU. And as I said, the only outlier was the Netherlands. And I think that matters in terms then of why and how we ended up with the Recovery and Resilience Fund. Because clearly the critical state in the Eurozone crisis was Germany. It was the constraining politics of the Federal Republic made it impossible, I think, for the Eurozone crisis to play out any differently than it did. But also Germany was the swing state here. France had already moved from the time Macron assumed power. He wanted more Europe, European sovereignty. He wanted a more maximalist Europe, whereas Germany had not shifted on the core taboos for quite a while in the COVID crisis. And here I think France, or Macron himself, played a very central role, because that letter that they sent to the European Council, if you remember, where he garnered support from lots of different member states, warned Berlin of two things. One, that Macron did not privilege the Franco-German relationship, but was willing to make the case with the other countries. And two, I think there was, as Marco said, the sort of self-interest that Germany could not afford to allow the deep cleavages of the Eurozone to re-emerge in a very pernicious way as a result of COVID. And that left the small frugals, but really only the Netherlands, as the holdout. And the Netherlands was not powerful enough, did not want to be at the right side in the end, did not want to deploy a veto. And neither did any of the other frugals, and several of the other frugals were non-Euro states. So the whole balance of power within the European Council had shifted. And then I'll end with one observation, and that is that we haven't talked about the United Kingdom, because obviously the UK is out. But I don't think it would have been possible to agree to the Recovery and Resilience Fund a la EU in its entirety via the EU budget had the United Kingdom been a member. There is nothing in the history of their preferences on budgetary politics in the EU that would suggest that they could have agreed. And if we even think back to Cameron at the European Council in December 11, where even the fiscal treaty was too much, then I could not see under any circumstances that a London government would have agreed. So this may be one of the few examples one can have of the benefits of Brexit, because there obviously are very few others. Thank you.
Thank you very much, Brigid. We've had a very interesting presentation by Marco and two complementary, very substantive set of comments. And now we have only about 10 minutes and a number of questions that are coming in. So what I will do is I'm going to collect all the questions, ask you three to take notes while I go through some of the questions. So we'll manage to have one more round of comments to some of these. So there is a question from Sandra Leopold about the role of the ESM. Is it missing in action? And if I can add to that, does that mean that tools that we use, we create in one particular instance become irrelevant when different circumstances arise? There is a second question about the overlap of the RRF and the multi-annual financial framework. That's Madeleine Bledarou. That's something that we have it now. We didn't have it in the financial crisis. And is that helpful now in particular that we did not? That's an element that we missed back then. Jean Pisani-Ferry, who is, of course, a chair at Tommaso Padoa-Schioppa chair at the EUI and also a Peterson fellow, is saying it's likely that the EU will have to rely more on fiscal policy. So how will that happen? Is it going to be a reform SGP, another PEP? What exactly will be the tools? Alex Stubb, the director of SDG, has come in with a question where he worries about the capacity of the Commission to act as a treasury. Basically, does it have the capacity to act basically as a bank, and how much will it be cooperating with the EIB in that respect? And let me conclude this with two of my own questions, if I may, because I have been listening to all of you and have been bursting with questions which I have not had the chance to ask. The first one goes back to the debate happening in the US about whether the Biden stimulus is too much or too little, or is the Biden stimulus too much? And there's a question here. There is a debate in the US whether it is indeed too much, but everyone seems to agree that too much is better than too little. So the question is, how will that US debate that we're watching at the moment influence the EU debate? Because there are two ways of looking at it. One is that people may say, oh, the US is doing so much more than us, which means that we have to do much more. And the other one is to say that, well, given that the US is doing much more, eventually, the Fed will have to press on the brakes, interest rates will go up, and therefore the EU will have to have a different response to the one that it's having at the moment. So how will that debate cross the channel? And the second one, Marco, in your presentation, you talked about two preconditions for making this a more permanent move in the EU institutional governance reform. Germany moving to on EMU issues, and Italy and Spain kind of moving towards more responsibility, as you called it. Well, this begs the question of, does the framework that the Commission has put out on the recovery and resilience plans, how do we ensure that this is more than box ticking on the countries? And yes, we have a different type of conditionality. I've read in detail all the instructions and framework that the Commission has put out, but how do we make sure that these, in fact, go to the heart of efficient use of this money, and therefore don't kick the debate back to where it started if we all see that all this money was not used properly? So there we go. Let's start with Marco, and then Brigid and Adam to close. Marco.
Okay, thank you very much. It's a bit of a pity we don't have more time, because I would have had a number of comments also on what Adam and what Brigid said. Now, let me maybe just a couple of little things there.
I'm sure we can go over a little bit, so please.
Okay. Now, I think on Adam, I think on R minus Y, I think yes, that's clearly improves the sustainability of higher level of debt. Level of debt have gone up in average in 2020 by 15 points. Some countries 25, some countries 10. But we have to always to remember that for individual countries of the Eurozone, the R is not the R set by the ECB. You have the country-specific risks that may be factored in, and you don't go back a long time than when we had the first Italian government after the latest elections. So the more populist strand, I mean, the change of the differential, the sign of differential changed immediately. So there also, I mean, maintaining a bit of prudence, I think, on the fiscal side is important. So definitely not austerity, definitely not too early exit on this, but for countries with very high level of debt, having an outlook where the debt level comes down gradually and continuously in a smooth manner, I think is important also to reassure the market, to make sure that the sign of the R minus Y remains I think the right one. What you say on automatic stabilizer very, very important. I think work done there by some actually Peterson fellows. I'm referring to Blanchard again. I think designing stabilizers which are not only the result of measures taken or let's say institutions and programs for redistribution and for allocation, so a derived effect of the stabilizer, but actually having stabilizer which target specifically stabilization, I think is an important line of thinking and policy program. So I think there is also for Europe, I think it's an important chantier for further work. what you say is on the series of shock, I think is actually, I have to say, is the question in my view. And I think you are absolutely right. Okay, let me use an image which is a bit gruesome, but we have an economic system which marches on one kidney and one lung. So when you have a problem, we go into crisis immediately. The human body runs on 2 lungs, 2 kidneys. So we would need, I think, to have a system which makes reserve for this type of events, potentially one after the other, so that you have the buffers in order to do so. So I think it implies a shift in approach, because basically you have to lower the discount rate of politicians dramatically for having to put resources in reserve for problems of that you outline. So this is in very general terms. I think if you translate it in practice, what I would say is that I mean, you have to improve the governance, and here I think if we have success from RRF, we may have also some side benefits of that. Studies show that the economic impact of the crisis is not only because of the different confinement, a different structure of the economy, but governance, quality of governance matters enormously. And second point is that at the European level, our response, we have crossed red lines in 2020, but under very weak institutional competencies. So on health, it is not up to us. So we have, in a sense, put forward and taken decisions, but which, however, I mean, if one thinks, if you have to run on 2 lungs and 2 kidneys, we'll have to review in terms of subsidiarities the relations between the Commission and the member states. In terms of policies, I think it's very clear. George said it. Doing too little now is far more dangerous than doing too much. Clear. And in terms of orientation of fiscal policies, if we enter into a series of shocks, I think it will have to go from a very broad, across-the-board crisis response to become, I think, much more targeted, because you will have to, unfortunately, conclude that certain activities will not revive, and you will have to shift the resources from one to another, not protecting jobs specifically, but protecting workers. So that is what I think where we should go. On Brigid, I think you mentioned the very interesting evidence on the political reactions. I mean, if you go to the studies, Alesina et Alice, or is the EU a political union? And it shows actually that the differences in political preferences and preferences for EU public goods across frontiers, across borders, is actually much lower than what one would have anticipated looking at behavior of politicians here in Brussels when they come for the European Council or for the various councils. So you have that kind of, I think, of effect. And indeed, I mean, you have also, apart from the Netherlands, Eurobarometer tells the same story that you indicated, that you have actually the quite a lot of support. So if you pass it through my Monet compatibility test, then I think at least on the third political strand, I think we have a chance, let's say, to build a response which enjoys also the support of the citizens. Very, very quickly on the rest, and ESM, I think ESM is a bit the victim of the history. I mean, and it's a pity because we in the pandemic instrument for support, the only conditionality that was left is that spend it for health, direct or indirect, so very broad, also no macroeconomic conditionality, but somehow the stigma has remained. And what you have also is a positive, or for the ESM in a sense a bit of negative interactions, because the response of the ECB plus the response of Next Generation EU lowered the spreads quite a lot. So it made the cheap loans from the ESM in a number of countries not particularly, convenient. So I think there was plus a bit this element of legacy of the stigma that is there. On Jean, yes, I think rely more on fiscal policy. I think we'll have to rely more on fiscal policy, be ready to do so. So I announce already what is going to happen next week. On the 3rd of March, the Commission will come forward with a communication on fiscal policy orientations for the spring package. So you will see there, we say a number of things also on the general escape clause, on how to implement the surveillance framework that we have, and eventually we will have to restart the debate on the review of the rules, and that will take place in the next months. George, Alex, I think we are equipping ourselves, as I mentioned, to become a treasury. I think the success that we had as a DMO for the SURE program, the 100 billion that I mentioned, has been actually spectacular. I mean, there is a demand there for a European safe asset, which we presume was there. We told the member states, you will get it, you will find it if you let us go in that direction. Now it is clear that there is a demand in this, and I think we have also on the supply side equipping ourselves well in coordination also with the EIB, with the ESM, and with the national DMO. Finally, US debate influencing the EU debate. I think here what Adam said in terms of the stabilizers, I think plays a certain role here. I mean, if we have to go for more, a stronger response, I think realistically it would come more from the national budgets than from the EU at this stage. We are now working forcefully to implement Next Generation EU, adopting the national reform and resilience programs. I think that is clearly the main task at hand. And if we need to do more, I think it will have to be in the context of a proper balanced policy mix, where the national component using the under the general escape clause of the pact will have to respond. Let me stop here.
Many thanks, Marco, for picking up most of the questions. For final comments, we'll start with Brigid and then Adam.
Well, I will just restrict myself to the question, Jean Pisani-Ferry, on fiscal policy and you on whether this is one-off or permanent. I think it has to be permanent, because one-off won't cut it for the EU over the next 10 to 20 years. What's very unclear to me is how it becomes permanent. In other words, what are the scope conditions that would allow for this paradigmatic shift to stick? One possible way is that through the creation of European safe assets, that helps with capital markets union, and in other words, the member states buy into common debt, that they see a benefit and the risks can be managed. I also think that the budgetary politics of the EU are about to get very hot. And why do I say that? That common debt will have to be repaid through the EU budget. That will have to come from an enhanced own resources of some kind, which probably leads us to EU level taxes of one kind or another. In other words, I think that there are ways that there is a scenario in which there is a virtuous cycle with reinforcing across several of these policy instruments and tools. And then, of course, there is it doesn't work. And I think the way in which the Recovery and Resilience Fund is used by the member states and how it's demonstrated to perform and to help really does matter on which of those virtuous cycle, vicious cycle will emerge from this. But I've no doubt that the politics of the MFF are only going to get hotter for the next cycle.
Thanks very much, Brigid. Adam, last word goes to you.
Very kind of you. That was obviously too rich a discussion, too many good questions. So just let me answer a few. I'm always more about results and policies, and that the institutions are endogenous to those. And so I never thought the ESM was worth a damn. It was just a stopgap measure because you didn't have reasonable forms of either conditionality or fiscal sharing. So the fact that it gets displaced doesn't interest me as long as it gets replaced by something better. Similarly, in the RFF, it's a structure for what it is now, but that doesn't mean it's of any lasting particular value. The fixation on institutions is something shared in the US and other places, and it's mistaken, as we've seen. Same institutions can be used for multiple different purposes at different times. So what's the problem? And that relates to Jean Pisani-Ferry's point about how do we expand fiscal. As Jacob Kierkegaard and I argued in a set of studies that Marco Buti's group commissioned from us a couple of years ago, the history of the US has some instructive guidelines that, and as well as the history of Europe, that you expand fiscal policy when you have something you want to deliver, as is the case right now with vaccines. And then you worry about how to pay for it later. And then once it's in place, it gets institutionalized. And so the issue, and this may resonate with some of the things Brigid was saying, I think the issue is that the European Union has to deliver things for people, including health and safety. And the more you offer at the European supranational level, the more support there will be for the fiscal envelope. Now, I think it was very interesting what you raised, George, and this is where I'll end, about what's going to be the takeaway for Europe and European discussion from the Biden package being too much. Again, I'm less worried about inflation than Blanchard or Summers, but I basically side with them that the $2,000 relief checks mostly are going to unneeded people, not unneeded people, to people who don't need it, excuse me. And so 25% of the package is probably wasteful. If you're doing state and local government aid, if you're working pandemics, if you're providing lengthier unemployed insurance, if you're providing eviction protection, which is what the package does, the rest of the package does. But that still means an enormous package compared to what's in Europe. My fear, which I've expressed recently in Hamburg and elsewhere, is that I think the Northern Europeans, in the spirit of discussion we've had, are going to look at any signs of waste or any signs of inflation in Europe and, in the US as a result of the package, and use that as a club to say, hey, look, this is irresponsible. We shouldn't be doing this. I hope I'm wrong. I don't think there is quite as much peer pressure to come up as there is to come down, but there is definitely a peer pressure aspect in the G7 and the G20. We saw that in 2010 with austerity. And so if we can have peer pressure, starting with Yellen, to push ahead in Europe, that would be great. But the other point is I will expect, even though it will be done quietly, some comment that if the Americans overstimulate, then we in Europe can stimulate less because, of course, they'll import stuff from us and we can free ride on that. And the dollar will appreciate and the euro relative to the euro probably in such a situation, and we can free ride on that. In the US context, I don't say that's worth worrying about. You should still do the right thing. But in the European context, I would be very careful as to whether that delivers the outcomes that Europe really needs.
Thank you very much, Adam, Brigid, and Marco for a presentation that gave us plenty to discuss. I think it's testament to how interesting discussion has been that we were 15 minutes over the time that we usually have for these 1 hour. We went over it by 15 minutes. So let us close it here. Thank you to everyone who sent their comments. Apologies that some comments we did not have the time to pick up, but thank you for coming in with them. And we hope to see you again in another edition of Florence Live. And finally, and again, thank you very much to our guests, Marco Buti, Adam Posen, and Brigid Laffan. Have a good evening.
Cheers.